Next concept is all about variance analysis. You might have heard a lot about this again in your accounting discussions, finance related discussions, and you had no clue. So after this lesson, you're going to have a very good understanding of what the concept of variance actually is. Now, standard costing is an accounting method which establishes estimates of the cost of products and then compares these estimates with the actual cost. Let's say I'm at the beginning of the year. Now at the beginning of the year, I do not know what the material cost will be throughout the year, right? In the first month, it can be $10 to buy wood. In the second month, it can be $20. It could be anything, and it keeps changing. So the standard costing method, if your business is using, which means it sets predetermined costs. Total predetermined cost of a product, let's say, is $10. Then at the end of the year, it compares that predetermined costs with the actual costs and then sees what the difference is like. These predetermined costs are called standard costs. So they predetermine the material costs, predetermine the variable costs, predetermine the fixed costs, and then they come to a predetermined cost per unit. This is then compared to the actual costs at the end of the year. And now in very common terms or in very generic business understanding, you will know that prices keep changing, right? If prices keep changing, meaning the difference between the predetermined cost and the actual cost will arise. There will be some difference. This difference is called variance analysis or variance. So the variance can be of two types. Now costs can turn out to be favorable. Wood cost right now, let's say, is $10 per pound. At the end of the year or throughout the year, it kept changing, became 8, became 6, became 4. So now it's costing you less to buy that particular quantity of wood. It becomes a favorable variance. Now, if the cost is a better scenario for you than the actual set cost, then the predetermined cost, we call it as favorable or F. It's in green. It's good for you. If the costs turn out to be lower, it's favorable. Whereas if the costs turn out to be higher, you predicted $10 of labor for 1 hour, it turned out to be $20. You had to pay $20. This becomes an adverse variance. So the difference between the predetermined and the actual cost is called variance. This can be favorable, good for you in green, or it can be not favorable or adverse for you in red, right in front of you. This is the concept of variance analysis. Very simple, very straightforward for you. Naturally, variances can be of very many types. There can be material variances, change in material price, sales variances, change in sales price or sales quantity, labor variances, variable overhead variances. We'll speak about the major variances, which from a business perspective, we should have some clues about. So there can be very many different types of variances in normal business scenarios, and we will discuss the same here. First, let's start with the most fundamental for any business, which is sales. Now, variances are generally split into two parts. The price variance, which means the price can go up or down. Second, the volume variance, which means the quantity can also go up or down, right? So sales price variance can occur, let's say, because you received a huge bulk order discount. Your price went down. Secondly, let's say prices increased. So price variance can be both ways, can become a good scenario for you, favorable, or can become a bad scenario for you, adverse. Same way, there can be sales volume variance, which means you expected to sell 10,000 pairs of shoes, but you could sell only 5,000. That also is an adverse situation, right? Why? It could occur because, let's say, your product is not good enough. There is an economic crunch. Anything can happen. On the other hand, you expected to sell 10,000, but you sold 20,000. This can happen because of successful marketing, good pricing. So remember, variances can be from the price perspective, good or bad, can be from the volume perspective, good or bad. We spoke about sales variances, we'll speak about material variances. For material as well, there can be a price variance, which means you expected the price to be something, but at the end of the day, it changed. So price variance can be because of market fluctuations, good and bad. It can be for, not purchasing the quality of material that was prescribed. Let's say you needed X quality of wood to make pencils. The price was too high. You ended up buying Y quality of wood. You compromised on the quality. So your price variance will be there, but you compromised on quality. So there can be a material price variance. Then there is a material usage variance, which means for 1000 pencils, you should use only, let's say 500 kilograms of wood. But because you bought a lower quality of wood, you ended up using 700 kilograms. So your usage variance, because of the lower quality, turned out to be higher. You used more. It's an adverse situation for you. So usage variance is how much you used. Price variance is the actual price that you ended up paying. Both can be good or bad for you. Always any variance can be adverse as well as favorable. In similar fashion, there is labor variance as well. So for labor as well, there can be labor rate variance. You expected to pay $10 per hour. You ended up paying $20. Is a situation, let's say seasonal fluctuations, seasonal demand, it can happen. It's not in your hands. So there is labor rate variance, and then there is labor efficiency variance as well, which means earlier your laborers were taking, or people that work in your factory were taking 10 hours to make certain amount of goods. Now a new machine was introduced, so it takes 5 hours. Your efficiency became better. It became a favorable situation for you. In another way, it can also be that a new machine was introduced. It started taking 15 hours because laborers don't know what to do. They're not comfortable with that method of production. Or also the efficiency can go down if there was a breakdown in the machine broke down, time was being wasted, can happen. So for labor, there is a rate variance and then there is an efficiency variance. So in this lesson, we learned about the concept of variances. We then spoke about sales variances. We then spoke about material variances, which was material price and material usage. We then spoke about labor variances, which was labor rate variance and labor efficiency variance. So throughout these lessons, we are trying to break down easy concepts for you, or in such a way that the understanding becomes absolute and you develop skills that you can use at work discussions or you can use for job interviews. All of this is basic knowledge that can really help you elevate your skills. That's the entire purpose of this course.